Welcome to my rapidly growing YouTube channel. For a chance to win a $50 gift card, please subscribe to my channel, hit the like button, and leave a comment below. A recession, according to the National Bureau of Economic Research, is a considerable drop in activity across the economy that lasts more than a few months and is observable in industrial production, employment, real income, and wholesale retail commerce. When firms stop expanding, GDP declines for 2 consecutive quarters, and the unemployment rate rises, a recession is thought to have occurred. The nature and causes of recessions are both obvious and ambiguous. Recessions are essentially a series of company failures that occur at the same time. Companies are obliged to reallocate resources, reduce production, limit losses, and, in many cases, lay off workers. Recessions have these distinct and evident causes. There are a variety of explanations on what causes a general cluster of business failures, why they occur at the same time, and how they might be avoided. Economists disagree on the answers to these problems, and numerous hypotheses have been proposed to explain them. 2 consecutive quarters of negative GDP growth is the usual macroeconomic definition of a recession. When this happens, private companies often reduce production in order to reduce their exposure to systematic risk. As aggregate demand falls, measurable levels of spending and investment are likely to fall, putting natural downward pressure on prices. Companies lay off workers to cut expenses, causing GDP to fall and unemployment rates to climb. Firms' profit margins shrink during a recession on a microeconomic level. When revenue declines, whether through sales or investment, businesses try to eliminate inefficient processes. A company might, for example, stop making low-margin products or lower staff salaries. It may also renegotiate with creditors to secure interest relief on a temporary basis. Unfortunately, organizations may be forced to terminate less productive staff due to shrinking profit margins. In every given recession, a variety of financial, psychological, and real economic elements are at play. The major economic theories of recession concentrate on the financial, psychological, and fundamental economic variables that might contribute to the cascade of business failures that characterize a recession. Some theories look at long-term economic trends that set the stage for a recession in the years preceding it. Some people only look at the things that are immediately obvious when a recession starts. In any given recession, several or all of these variables may be at work. During the 2007 to 2008 financial crisis, financial considerations played a role in the economy's descent into recession. Excessive credit and debt on risky loans and marginal borrowers can result in a massive risk buildup in the financial sector. The Federal Reserve and the banking industry can take this process to extremes, fueling dangerous asset price bubbles, by increasing the amount of money and credit in the economy. Artificially reduced interest rates in the run-up to a recession can affect the nature of interactions between firms and consumers. It happens by making interest rate-sensitive company ventures, investments, and consumption decisions, such as buying a bigger house or embarking on a risky long-term business expansion, appear far more enticing than they should be. When interest rates rise, the failure of these decisions to reflect reality is a major contributor to the spate of business failures that characterize a recession. Economists frequently point to psychological aspects as contributing to recessions as well. During the boom years, investors' excessive optimism propels the economy to its pinnacle. At the very least, the reciprocal doom and gloom pessimism that follows a market crash increases the influence of genuine economic and financial causes as the market swings. Furthermore, because all economic activities and decisions are constantly forward-looking to some degree, subjective expectations of investors, businesses, and consumers are frequently engaged in the onset and spread of an economic slump. Beyond financial accounts and market psychology, real changes in economic fundamentals are also important contributors to a recession. Some economists attribute recessions exclusively to basic economic shocks, such as supply chain breakdowns, and the resulting harm to a variety of enterprises. Shocks to essential industries like energy or transportation can have such broad ramifications that they force many companies across the economy to cut down and cancel investment and employment plans at the same time, affecting workers, consumers, and the stock market. There are a number of economic issues that can be linked to financial markets. Market interest rates reflect the cost of financial liquidity for firms as well as consumers, savers, and investors' choices for current versus future spending. Furthermore, artificially suppressing interest rates by a central bank during the boom years before a crisis distorts financial markets, as well as corporate and consumer decisions. All of these elements have the potential to produce a recession in the future. As a result, the preferences of consumers, savers, and investors limit how far such an artificially induced boom may go. Economic restrictions on continuous expansion appear as labor shortages, supply chain bottlenecks, and commodity price surges, which lead to inflation. Due to higher production costs, a rash of business failures may occur if not enough resources are available to sustain all of the business investment plans. This predicament has the potential to send the economy into a downturn. The National Bureau of Economic Research reported in February 2020 that the United States was in recession, based on their data, due to the economic shock of broad disruption of global and domestic supply networks, as well as direct damage to firms across all industries. The COVID-19 outbreak and the public health response were at blame for these incidents. Overextended supply chains, razor-thin inventories, and fragile company models were some of the underlying reasons of the 2-month recession and economic suffering in 2020. According to the National Bureau of Economic Research, the pandemic-related recession ended in April 2020, although the financial hardship induced by the pandemic continues to affect Americans. I hope you find this information helpful. For a chance to win a $50 gift card, subscribe to my channel, like the video, and comment. Bye for now.